Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news China is hunkering down with a new private company rescue package on the way. But first, all eyes will be on Adrian Orr and the RBNZ's monetary policy statement at 9 o'clock this morning, especially after yesterday's dramatic surprise with our labour market data and the sharp rise in inflation expectations. We'll have full coverage, of course. Elsewhere, Wall Street is rising and is up 1.6% in the afternoon trade as investors piled into technology and healthcare sectors after their midterm elections led to a divided American Congress as expected. This is raising expectations that tighter regulations will be harder to push through Congress, making it easier for a dominant sector to remain with those market advantages. Investors seem to be able to live with a deeply divided country, even as the US dollar fell and there was a shift to bonds and a risk-off mood. US mortgage applications fell more than expected, down 4% in a week. That puts them at their lowest level since December 2014. The average contract interest rate for a standard 30-year fixed-rate mortgage backed by the FHA rose to 5.15%, a 7 basis points jump in 1 week. And we're awaiting US consumer credit data from the US Fed for September, and markets expect a small slowdown from August. When that data lands, we'll update in the story below. On tariffs, Gary Cohn, the recently departed Trump administration chief economic advisor, has described tariffs as a tax on Americans, saying what all economists know, but what a financially illiterate president and many voters can't get their head around as they pursue short-term jingoistic trade policies. China's foreign exchange reserves were lower in October by $34 billion, but still managed to stay above the psychologically important $3 trillion level, just. And China's central bank has launched another fund to supply equity finance for companies no longer able to get it from investors in normal markets. This is an indication of the seriousness of their current credit crunch and lack of confidence in the economy by investors. Apparently, forced takeovers by SOEs isn't enough to prevent many private enterprises from going under. One sector particularly hard hit is property development, where Standard & Poor's is warning of a rising default risk. Belt-tightening stories for consumers are starting to appear too. In Australia, the new sport for economists seems to be outdoing each other and calling the size of their housing market declines. Macquarie analysts say the overall decline could be 10%, with nominal prices in Sydney and Melbourne being more like 20% from the peak. At those levels, that would make it the largest housing market retreat in 40 years. The US Treasury 10-year yield is down 1 basis point to 3.20%. Their 210 curve is now under 26 basis points. The Aussie government 10-year is at 2.73% unchanged. The China government 10-year is at 3.52 and down 2 basis points, while the New Zealand government 10-year is at 2.77%, up a remarkable 10 basis points today. Gold is up $2 overnight to $1,228 an ounce, and US oil prices are still under $62 a barrel, while the Brent benchmark is now just over $72 a barrel. The Kiwi dollar is starting today much firmer at 67.9 US cents, which is more than 1 cent up in a day and 2.5 cents up over the past week. On the cross rates, we're up to 93.3 Aussie cents, and that's a 5-month high, and we're at about the same at 59.2 euro cents. That puts the TWI at 72.1, also near a 5-month high. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.